one can't leave this without talking about incentives in financial markets. It is also the case that the whole incentive structure paid for short-term returns, and there were many examples of this, annual bonuses, that sort of thing, and there was not enough downside for losses. So there was an incentive to take risks which generated good returns most of the time, but with a small probability of disaster. And unfortunately, when the disaster came, the people who had taken those risks had pocketed large amounts of money, and the legal system was not in a position to get it back. So this is going to, so that's my kind of summary of the kind of, if you like, the high-level reasons for the financial crisis. As I said at the beginning, a lot of things have to go wrong to have a crisis as big as this one. I'm now going to shift gear again and show you what some of my wow graphs. I think they're wow graphs anyway, because it just gives you an idea of how extraordinary some of the developments have been. Let me start with the graph with an incomprehensible title. I'm going to try and explain what this is, and I could just as well have called this whatever, this graph, but you'll get the point in a minute. What this is supposed to show, what this LIBOR, for those who care, is London interbank offer rate. But what this graph is going to show is, the best way to think about this graph is it's the amount that banks charge each other when they lend to each other for 3 months. So a way of thinking about this is a bank, if it's got some spare money for 3 months, could put that money with the central bank and get a certain interest rate, or it could lend it to another bank. And in normal times, it's going to charge a very small premium for lending it to a bank rather than to the central bank being the Reserve Bank in Australia's case. It's going to charge a very small premium for lending to another bank because that other bank, even though it's pretty safe, is not the government. So there's a small premium, which you can see there at the bottom of the chart, just a tiny weeny premium that they charge when they lend to each other. And no one ever drew this graph for reasons that are pretty clear, because it's pretty boring. Nothing ever happens to this chart. Now, those different lines are for different countries, but you can see right there, right near the end where I've stopped it, something's about to happen. That's the start of the financial crisis. All of a sudden, banks in these countries, started charging each other serious premia for lending to each other. So we are talking about, in Australia's case, highly profitable banks with effectively no chance that they will be insolvent over 3 months. It's effectively not going to happen. But nevertheless, this market became moderately dysfunctional, and banks were charging each other quite significant premiums. Then, over a weekend in the middle of September of 2008, Lehman Brothers fell over. Now that sounds very esoteric, but Lehman Brothers was connected to almost everyone in the financial system. And when Lehman Brothers fell over, banks said to each other, well, if that can happen, then just about anything can happen. And that's what happened to these spreads. Now we are back down to roughly where we started. Well, I mean, not where we started, but where we were before Lehman Brothers fell over. But nevertheless, there was a time there where the interest rate that these banks were there wasn't a lot of trades going on at those prices. So if you can lend to the central bank for, let's say, I don't know what the short-term interest rate in the US was at this time, but let's say it was 1%, be about right. If you are going to lend to another bank, if they're going to charge you an extra 3.5 on that, then you're not actually going to do a lot of that lending. So the market simply stopped functioning, but to the extent that there was a price, that was what the price was. Now, that didn't just happen in the 3-month money market, it happened all across the financial system. So I'm just going to show you another example. This is the interest rate that, as you would probably be aware, the euro was formed in 1999 when a bunch of countries in Europe got together and agreed to have a common currency, which they would, so they did away with their own currencies and they all had a common currency. And as that became bedded down, international investors increasingly regarded lending to one European country as pretty much like lending to another European country. They charged only very small premia, whether you lent to the Germans for 10 years or whether you lent to the French or the Spanish or the Dutch or whoever else. Again, this was kind of an interesting phenomenon. This was a sign that the euro was becoming a part of the scenery, and everybody was happy to lend to any of these countries. What happens with the financial crisis? A huge blowout in a huge change in people's perceptions of how safe it is to lend to different countries. So again, these are very big changes in interest rates. So if you were Ireland, which had been the darling of the, if you look here, there was a period when Ireland could borrow cheaper than Germany. That's if I can get my arrow. There was a period here where Ireland borrowed in international capital markets for less than the Germans did. So the spread was negative. So they were below the German interest rates. And now they have to pay between 2 and 2.5% more than the Germans. And on an interest rate of, German bonds interest rate is about 4. So the Irish interest rates are at the long end of more like 6. And that's very expensive. So that's just another example of of spreads just blowing out incredibly in this time. Okay, now I'm going to move to the real economy and give you a sense of how quickly things changed. Here are, some people put a graph up like this in order to make fun of the IMF, but as a forecaster, I know that you don't want to make fun of other forecasters. Forecasting is a difficult business. What is this chart showing? It's showing the IMF's forecasts of growth in 2009, the forecasts that were formed at different times. So the IMF, through 2008, repeatedly updated their estimates of what growth in the G7, so for those of you who don't know, the G7 is the large advanced economies, so that's the US, Canada, Japan, and the 4 large European economies, UK, France, Germany, and Italy. That's the G7. And so the left-hand panel is, if you like, what the IMF thought would be growth in 2009 for the G7, and the right-hand panel is what they thought growth would be in the world. And the thing that's striking is from April to June of last year, they actually slightly upgraded their estimate of what growth would be in 2009 in the G7 and the world. So they actually thought that the financial crisis was, which after all had broken out in the middle of 2007, was pretty much under control. But with the collapse of Lehman Brothers, they got over that feeling, and they have been downgrading what they thought would be growth ever since. Negative growth for the world in 2009, which is what they're now predicting, this will be the first time in 60 years that the global economy has actually contracted. So now I'm going to show you some country examples and to show you just how striking some of these developments are. In the US, in the housing market, that's what's happened to housing starts on the left-hand side. So they were kind of growing gradually through time, and then they fell off a cliff. And housing starts have simply gone down to a quarter of their previous level. So they were building 2 million houses, I guess it's per annum, I think that'll be the scale. They were building houses at a rate of 2 million per annum, and now they're building them at a rate of 500,000. And then the right-hand side shows you the total number of houses for sale. So in a market that's functioning properly, you have of the order of 2.75 million houses for sale, and now that number's more like 4 or 5 million because there's simply a huge stock of houses out there that are not selling.